Okay, and welcome to Chapter 3. I decided I was going to do 2 videos for Chapter 3 that might be a little longer, so they might be around 20 minutes. There just wasn't a good place to split it up 3 ways. So we're moving on to Chapter 3, which is adjusting journal entries. Up to this point, or what we did in Chapter 2, is we did a whole bunch of what I would consider normal business transactions. And what do I mean by that? I mean by transactions. I mean that there are things that are that have some sort of action to that, some sort of action, or maybe they're kind of visible. And those are going to be things like we took out a loan. We made a sale. We bought inventory. And you can see this is where someone in the company is doing something. They're interacting with a loan officer, or they're interacting with a customer or a vendor. Something's going on. There's some paperwork trail. There's something being generated, and there is some sort of visible action. However, there are a certain class of other transactions that we need to take care of, and they're adjusting transactions. So what are they, and how do they fit into all of this? Well, up to this point, we've been taking all these business transactions and then putting them on the accounting equation. Assets equals liabilities plus stockholders' equity. And remember, that also includes revenue, expenses, and drawings. So what is the whole purpose of doing all these business transactions, fitting them into debits and credits, and putting them on the accounting equation? Well, the business transactions are what end up filling up the financial statements. And if you remember at the end of Chapter 2, we basically went through a round of looking at a series of transactions, putting them on the accounting equation, figuring out the debit and credit, and then figuring out their T account and the trial balance, right? And that was something that we did as far as a process. Now, remember, the financial statements are standardized, meaning they have rules, and the rules are according to GAAP, the generally accepted accounting principles. And why are they standardized? Because the financial statements are for external users, meaning who are those people? External users are going to be people like creditors, people who are maybe wanting to loan you money or give you an account at their store. They're going to be investors. It could be either people who've already invested or are potential investors. And then, of course, the government. And, you know, for right now, our primary concerns are probably the IRS or the SEC if you're a public company. Now, for the whole purpose of having a standardized set of rules to run your financial statements is that there is going to be some regular process to putting them together. And that is what we have started on. We have started on this regular process. And in fact, now we're going to name it. This regular process is called the accounting cycle. And this accounting cycle, well, we started off in Chapter 2, and we said that there was journal entries and post and trial balance. Well, let's put this together in a little bit more formal fashion. So there's going to be a series, there's going to be a number of these steps that we need to take, and they come in I guess series of 4. There's going to be 3 series of 4 steps, and the first step of each of these is there's going to be some trigger. There's going to be some trigger that tells us we need to go ahead and start. Now, the trigger for the first one is to analyze a business transaction. In other words, it's during the regular workday, something comes in, a loan, a sale, inventory, something happens. We analyze it, and we first say, is it accounting? Meaning there are some transactions in the company that are not accounting focused. If we hire a new CEO, there's no debit or credit for a CEO. There's no T account for a CEO. Or if we get an account, if we win an account, nothing has quite happened yet. So first thing is we analyze all the normal business transactions and decide, A, is it something we need to record? And B, well, if it is something, what is the debit and the credit? And that's where we go through the accounting equation. So we create a journal entry. That's that debit and credit. And where do we put all these? Where do these things live? They live in the general journal. So each individual transaction has a journal entry, and all together they live in the general journal. Then we post them, and that is where does all the posted material live? In the general ledger. Now both of them use the word general. And for right now, we're using a simplified version, a T account. But that is posting it, because the journal entry looks at it from a transaction point of view, and the posting breaks them all apart and looks at it from an account point of view. In other words, all the cash items go together, all the inventory items go together, and then we put those on a trial balance. And that's where we ended up at the end of chapter 2. So that was chapter 2. So you notice we have 4 steps. Analyze, which is our trigger, journal entry, post, trial balance. Well, it may seem like we've got a lot of things, but really it's very repetitive. The next series of 4 is, well, what is the trigger? So now we're talking about what's going to be what we're studying here in chapter 3. The trigger is the end of the period. And what do I mean by period? Well, it could be the month, the quarter, the year, whatever, when we're getting ready to do the financial statements at the end. And what happens there? Well, then we look at this next set of transactions, which are called adjusting transactions, and we make an adjusting journal entry. They still live in the general journal. Then we go ahead and post them, and then we have an adjusted trial balance. So you notice steps 2, 3, and 4 of both of these cycles are the same thing. It's just the trigger and the type of transaction that we're dealing with that's different. In the first one, we're dealing with normal business transactions. The second one, we're dealing with adjusting transactions. And we finish up in chapter 4, the next chapter. What is the trigger? We've actually created the financial statements, the income statement, the balance sheet, etc. And now we need to close the books. You probably heard that phrase before. Oh, we'll talk about it when we get to chapter 4, but just realize if I'm going to go ahead and sketch in the whole accounting cycle, it's going to be closing journal entries. We're going to post them again, and we're going to have a closing trial balance. And again, closing entries are a little different from adjusting entries, which are a little different from our normal business transactions. So here we have it. We've got the whole accounting cycle, and we're taking 3 chapters to cover them. Chapter 2, chapter 3, and chapter 4. So we're going to be halfway through once we cover chapter 3. So let's kind of talk a little bit about these adjusting journal entries. Well, for chapter 2, what triggered a journal entry? Any sort of normal business transaction. But here, what triggers the adjusting journal entries is the end of the period. And more specifically, what we want to say is it's the passage of time. In other words, there's going to be, I'm kind of goofed that up, passage of time. There's going to be certain journal entries that we don't really pay attention to, that are not as visible, and that we only know we need to do something with the account because time has passed. So not as visible. And basically, it is the accountants who have to keep track. And what happens at the end of the month? Well, we have certain types of transactions where we have to update the status and say, okay, a month has gone by. What has changed with these accounts? No, I'm not trying to be mysterious. We're going to talk about what type of accounts they are here in just a second. So update the status. So an adjusting journal entry, this thing that we're looking at the end of the period, Well, why do we do them? And what is forcing us as accountants to record these? Well, they're based upon two principles or two rules. The first one is called the revenue recognition principle. And what does that say? It says we only record, or if you want to say recognize, revenue when it is earned. So now we need a definition of when it is earned. Earned means if it's a service revenue, in other words, something we do for the customer, it's we have performed the service. If it's we're selling them something, it is we have provided the goods. That is when we record revenue. Now you notice in this definition, there's no talk about the cash changing hands, and that's important. The other principle is something called the expense recognition principle. Principle. And a lot of times we call this the matching principle, which I will show in just a second. And it's almost the same as this other one. We record an expense when it is incurred. And so what is our definition of incurred? Well, for every revenue that we record, revenue just doesn't pop out of thin air. We had to have used something up to generate that revenue. Either we sold them inventory, so we had to have used some inventory, or if we did services, we had to have some labor, right? We had to have some wages. So whatever expenses, whatever we used up to generate the revenue, that is what we call incurred. It's sort of our day-to-day expenses, but they are tied to the revenue. And it's tied because maybe it's directly tied, like we sold this inventory, or it's tied indirectly in that it happened in the same period. In other words, we may have had a bunch of sales at our store, but the rent wasn't tied to any particular sale, but we could apportion the rent among all the sales. So it happened during the same time period or the same month. And that's why I say we match the expense. That's what we call it the matching principle. We match the expenses to the revenue. What expenses were necessary to generate the revenue? So you notice that the adjusting journal entry, the two rules that we're following here are focused on revenues and expenses. And additionally, notice it's key. We don't talk about cash. And in fact, that's the whole purpose of adjusting journal entry. Something happens to a revenue, something happens to an expense, or something happens to an expense, and it's not tied to cash. So if we take a look at this sort of diagram, we're going to create a little diagram of, there's a lot of situations up to this point where we've talked about making a sale and the cash changes hand, or an expense and a cash changes hand at the same time. But if we had revenues and expenses, and we're not so focused, we know when we record the revenue, that's when we perform the services or provide the goods, and we know when we record the expenses, it's when they're tied to the revenue. Well, that kind of frees us up to say it could be the cash happens before this event, or the cash happens after. So you notice we've got sort of a 2 by 2 matrix, right? We've got revenues, cash happens before, revenues, cash happen after, or we have expenses, cash happens before, and expenses, cash happens afterwards. And those are our 4 adjusting journal entries. There are going to be 4 different types, and we're going to go through and explain. Got to remember to wiggle the mouse. We're going to go through and explain what each of these are. We're going to go through and explain what each of these are and also give examples. So let's, for right now, just name them. And they're not so strange that you haven't already kind of encountered them somewhat. So here, if we had a situation where we made a sale, so credit revenue, it doesn't matter the dollar amount, but the customer didn't pay us right away. They said they promised to pay us later. We already looked at that as being a debit to an accounts receivable. And later on, when the customer does pay us, we debit cash because we've received the cash, and we credit the AR. So notice that the AR, oh, let's see. Yeah. Notice that the AR cancels out, and we're left with a cash sale. So really what's happening here, maybe this happened on the first of the month and this happened at the end of the month. So it ends up being a cash sale. It's just separated in time. And that's what adjusting journal entries are. Remember, we said it's passage of time that defines these things. Now, when we record the AR, we're basically saying revenue happens first. We go ahead and record the revenue first, and later on we record cash. So this is a situation where revenue happens first, or revenue happens and then the cash happens later. So we're not going to call it AR, but this sort of situation of an AR is an example that we've already experienced where we record the revenue and first and the cash happens later. So we're actually going to call this an accrued revenue. And we're going to get into examples for all of these in the next video. So let's just go ahead and name these. This side will be an accrued expense. This side will be called an unearned revenue. And this will be called a prepaid expense. So we've got 4 different items here. Now the ones on this column, we actually call accruals. And I know it's sad that they couldn't come up with another name because we've already defined accrual accounting as being something, but we also have this side of the chart being called accruals, and these are called deferrals. Sorry. I got that backwards. I wrote the chart backwards. We call these deferrals, and we call these accruals. Because we're accruing the revenue. And what do I mean by accrue? Accrue means bring forward. So the revenue, we're accruing the revenue or accruing the expense. So we're bringing forward the revenue or expense. And deferral means to put off till later. So we receive the cash before, and then we defer the revenue or we defer recording the expense until after the cash happens. Okay, so those are where the adjusting journal entries come from, how they fit into the grand scheme of the accounting cycle. And now we've named them and kind of given a little bit of the definition of them. What we're going to do in the next video is go through each one of these and give an example that will be very similar to what's in the homework. And we'll do a little bit more of explaining kind of what they are and why they work the way they do. Okay, see you in just a little bit.